Bismillah ar-Rahman ar-Rahim. Today, inshallah, I'm going to talk about mutual funds portfolios, the different measures of risk and return adjusted for portfolios, and different classifications of mutual funds. Just to remind you about the importance of mutual funds. It helps individual investors to have expert people and to have different classifications of the mutual funds, and this by pooling a huge volume of the investment transactions coming from different resources, which consider as a cheap financial resources. Today, the different classifications of mutual funds, I will focus on the different types and different investment style. Okay, different types refers to different asset classes. Okay, the asset classes includes the capital market classes and money market classes. Just be focused in here. The capital markets, the capital market instruments, and we have money market instruments. Well, this is for the classes. Take the capital market instruments. Includes the stocks and bonds. Okay? Pay attention, please. Stocks, we have common stocks, and we have preferred stocks. For the bonds, we have different bonds. In general, we classify them into two main types. The municipal bonds, the corporate bonds, and government bonds. Okay. Within the family of corporate bonds, we have different bonds. For instance, we have high rate bonds, we have low rate bonds, like the junk bonds. The junk bonds is for the lower credit worth companies. For instance, if we have a company challenging problems in liquidity or challenging bankruptcy, they issue junk bonds. And junk bonds is characterized by the high risk and higher return. Okay, and we have high rate bonds, which this issued by the high categorized or high credit worth companies, which consider as lower risk and lower rate of return. For the government bonds, we have different bonds. For instance, we have treasury bonds, we have treasury notes, and we have municipal bonds. Okay, let's go back for the stocks. In addition to these classifications, from the investment point of view, they categorize stocks in different ways. For instance, we have value stocks, and we will go in details about this. We have growth stocks. We have mixed or combined. Is a combination between the value stocks and the growth stocks. إذن the capital حكينا إنه فيه we have stocks, we have bonds. We have different categories of stocks. We have value stocks, we have a growth, and a combination between value and growth. This is from the investment point of view. For instance, if we talk about the growth, the stocks categorized as a growth, it means there is appreciation in the price. There is a growing in the price, like the technologies, like the pharmaceutical companies. Pharmaceutical companies and the tech companies, they prefer to retain earnings. And because they retain earnings, they do a lot of investments and impact the investment on the price will go up. So this is the idea of the growth. The value stocks, this stocks is like the undervalued stocks. Undervalued of stocks, it means mispriced stocks. So investors, they prefer to invest in this, and because they think the future will correct the price of this stock, and then the price will go up. Different ideas around the investment in the stocks and either in bonds. This is for the capital markets. For the money markets, we have different classifications. Before talk about the different classifications of the money markets, the capital markets, which is already you know about this, when you had the financial management, the capital market is characterized as a long-term market. Okay, and relative to the money markets, it is high fluctuated and holding higher risk and higher return. This is relative to the money markets, because the longer the investment, the higher the rate of return and the higher the risk. For the money market instruments, is short. Money market instrument is short and holding lower rate of return and holding lower risk. And in addition to this, it's easy to convert into cash. It's more liquid and more marketable. Let's take some examples of the money market securities. For instance, the most important is the treasury bills. The treasury bills is issued by the governments and holding a free interest rate.
Higher risk?
No, lower risk. Lower risk. Yes. Sorry. The treasury bills holding lower risk and lower return. And in other way, it holds a free risk. A free risk. And it's located in, this is the risk-free, representing by treasury bills. So the treasury bills, which is issued by the Federal Reserve Bank of the United States, considering having no risk. The risk that only they hold is the inflation risk. This is the treasury bills. We have the certificate of deposit. Certificate of deposit is issued by the banks and is certified by the commercial banks, holding lower return. If you look at this chart, you will observe where is the treasury bills and CDs and other securities are located in the security market line. Look at here. Here is the treasury bills. Okay, and just little further away is the certificate of deposits. Then we have the commercial paper. Commercial paper. You know about the commercial paper? The commercial paper is similar to the certificate of deposit, but the commercial paper is issued by companies, not by banks. Instead of using or borrowing money from the banks, the company is issuing the commercial paper to fund their short-term activities. And this commercial paper is traded between the investors by discount. And the treasury bills, by the way, is discounted on the money markets. For the CD, hold the interest rate. We have a euro dollar. Euro dollar, any United States or any instruments holding a dollar, a United States dollar, traded outside the United States is considered as a euro dollar. And it's characterized by lower rate of return and lower risk. Investors, they do prefer to hold the euro dollar because to keep themselves away from the regulation of the Federal Reserve Bank. So it is good for them to invest in these instruments. We have also the repurchase agreements, which known as repos. Repurchase agreements considered as a repos. The repurchase agreements is resulted from the international trades. From the international trades, like the LCs, letters of credits. You may go back and Google about the letter of credits as an instrument to facilitate the international trades between the foreign traders and the local traders. When the idea of repurchase agreements, this one is you are buying now, or you are starting by selling now, and at the same time you agree to buy it back in the future. Buy it back in the future. Sorry? No, it's different.
Why?
Because you are now holding the instruments. For instance, I need money, and I have this mobile phone, but the money is coming later after 10 days. But now, urgently, I need, for instance, $100. So what can I do is sell this now, okay? And at the same time, I agree with the buyer to buy it back after 10 years. So after 10 days.
As a collateral?
Sorry?
As a collateral?
It's considered like collateral, but it is not collateral. This, I need, for instance, $100 now. I hold this mobile, okay? But after 10 days, I will receive $100.
Yeah.
Now, this mobile is $100, okay? Today, I sell it off. But in the future, I don't know what is the price of this mobile phone. So I agree on this, on the time of selling, I agree to buy it back. To buy it back at the same price, but just pay little commission. So this is called the repurchase agreement. You repurchase your assets because your $100 is coming after 10 years. Okay? So it is not like loan, but it's just giving loan for 10 days. And if you talk about this as a collateral, yes, it's considered as a collateral. And this is traded. This is well known in the financial markets.
This agreement bind the buyer to sell it back?
Yes, this agreement is through the dealer or through the broker. So the dealer guarantees for you he or she sell it back to you after 10 days. And the dealer commission, the dealer percentage is considered as a repurchase rate or repos. Okay, yes, repos. And it is common in the financial markets. We have banker's acceptance. Banker's acceptance. The banker's acceptance, this is banker's acceptance resulted from the international trades. Let's explain the banker's acceptance. We have exporters and we have importers. Let's see, the importers is located in Palestine and the exporter is located in China. Okay? Now, the importer send, say, cheque accounts. Okay, cheque accounts to the Chinese exporter. Then the Chinese exporter send goods to the Palestinian importer. Okay, now the Chinese asking the Palestinian bank to confirm the cheque account, to put the stamp of the bank. For instance, this is the cheque account, so the bank has to stamp it. It means is accepted. What means accepted? Accepted. What it means accepted? It means the bank guarantees to pay to the Chinese exporter the due amount on the time of the maturity. Let's consider this mature after 6 months. This cheque account is mature after 6 months. If the Chinese guy or exporter need the money after 3 months, what he or she can do? Yes, he can trade in this. He can sell it or discount it with the commercial bank or with the other investors. This is the banker's acceptance. And again, it's well known in the banking system. So far, we know about the treasury bills, CDs, commercial paper, euro-dollar, repurchase agreement, banker's acceptance. We have the overnight loans. Overnight loans. Overnight loans, it is instruments between banks. Only for one night. For instance, the bank needs dollar tomorrow or euro tomorrow, and they don't have in their inventory. So what they can do, they can lend or they can borrow the money from other banks. This is then known as overnight loans. How they determine the price of overnight loans? By using LIBOR. LIBOR is a stand for London Interbank Over Rates. So using LIBOR as a pricing system for the overnight loans. And again, this is well known in the banking system. I recommend my student to read a lot about these things, because if you have opportunity to interview in any vacancies in the banks, particularly in the treasury departments or investment departments, they will ask you about these things, because you will know about these things very much. Every day, every morning, every night, you will deal about even in Palestine, we have for instance, euro-dollar, we have repurchase agreement, we have bankers' acceptance, we have overnight loans, we have LIBOR. Every day you have to say good morning to LIBOR. Before open your eyes, okay, you should see LIBOR. Because the LIBOR is determined, the interest rate, determine the deposits, determine the loan rate, so it's very important. don't think these things in the moon. Okay? Because some of my students, they think, yes, they think these things, you don't need them. No, you need them every morning and every minute sometimes to look how the fluctuation of the price of these instruments. So we took a journey around the main difference of the capital market and the money market securities. So why we need them, why we need the money markets and capital markets to help us to combine appropriate portfolio or efficient portfolio. If we don't have experience about the criteria of each instrument, so we challenge problems. In the morning, I read around the mutual funds. I mean the recent technology in the mutual funds, and the conclusion is at least the investment companies provide more than 200 different types of mutual funds. You see, it's like mobile phones. So even in the mobile phone industries, we don't have 200 different types provided by one single company. So you can observe to what extent the importance of the mutual funds for the developed economics. Okay, let's go back to our train and to see how these instruments help us to forming our investment type and investment style. Any question? Try to Google these things. Try to look at different videos, different experience. It's important. Okay. No question? Okay, now let's go back to the type of investments. As I explained, type of investment is related to the different families, different classes. Capital market instruments, money market instruments. The big question is, which is the good mix for you? Money market, capital market, 50-50 or 30-70 or 70-30 or 20-80. It depends on the policies and the investor style. The investment style, it's important because investment style determine your level of risk, determine your preferences regarding the different asset classes. So you know these the different design, and now you select the design that fits your size. So this is the idea of investment style. What is your style of investment? Generally speaking, when we talk about the style, we talk to invest in small companies or large companies. To invest in value companies, growth companies, or balance between the value and the growth companies. In generally speaking, style, you should determine in the style your strategies and your policies. If your investor advisor, I mean the registered officer, if he or she failed to address your strategies and policies, it means he or she is misleading you. Now this is the connection between the previous chapter and the current chapter. The types of investments. We have growth funds, and we explain the growth funds, the securities which appreciated the investors. The prices is growing up, and the prices is growing up because of the investments. Because of the investments. The big question of the growth, this is the income statement, or this is the income value. Companies have policy regarding the dividends, either to to pay dividends or retained earnings. The importance of retained earnings is making the stocks to grow up, because they reinvest, they do expansion. And doing expansion, it means increasing the value or maximizing the firm of the company, the value of the company. For the dividends, dividends is important also, but is securing a cash flow for a particular people. I will give you 2 examples with 2 different companies. For instance, in retained earnings, the majority of tech companies, technologies, and pharmaceutical companies, because they depend on research and development, they retain a lot of money for research and development. Hence, there is a lot of expansion and investment, and the price will go up. Let's take foods industries. In the foods industries, or let's say the coffee shops, or let's talk about the McDonald's, they don't have that big investment relative to the Google or Microsoft or Apple or other IT companies. Okay? You just see McDonald's. What is the recent invention in McDonald's industries? What is the recent? The recent things is to consider the diabetes things, to consider to write notes about the ingredients of how many calories in this is the recent things in the technology and developing the food industries. So they don't have that space to big investment. So they pay dividends. We don't say that dividends or retained earnings is much better than the dividends, retained earnings. No, the idea is we have different attitudes, we have different types. So investors, some investors they prefer this, others they prefer this. And this is the beauty of diversification and the classifications. For instance, if all companies listed in the stock markets return their earnings, it means we don't have cash flow. Okay? And if all companies, they pay out their income, it means we don't have growth. So we need a combination between the growth and the dividends, which is the balanced funds. The balanced funds. So the balanced funds is a combination of different assets with different criteria and with different categories. For instance, you have stocks, growth stocks, and value stocks. If you talk about bonds, you may have corporate bonds and government bonds. Corporate bonds having higher return and higher risk, the government bonds having lower return and lower risk. Okay? And at the end of the day, you are balancing between the dividends and capital gains. The income funds. The income funds is coming from dividends. And this is good for retired people. I ask a question for in the exam about, I give them 3 different types of return. Like this. We have A, B, C. And all of them give 14% return. All of them. But we have dividends and we have capital gains. The dividends is 0, the capital gains is 14%. In B, the dividends is 14% and the capital gains is 0. And in C, let's say here is 9 and here is 5. Now the question is, now see the question. Which stock paid higher tax?
B.
Are you sure B? No? Definitely no. This is A. Why A? Yes. Why it is A?
Evidently,
Why A?
because higher capital gains
Okay.
and
The- are you sure it's A? B. I'm trying to confuse people or to confuse the students. So she's right. So higher dividends, it means higher tax. Okay, so she's right. B. Now, which one having higher income? Also B. Also B. Which one paid lower tax? A. Yes. A paid lower tax. Which one is preferable to the retired people? B. B is preferable to the. Which one is preferable to the risk lover people? A. You have just one single example, and from you drive many questions. From this one single, you can build exam on just on the 3 stocks, on 3 different combination of the assets, because in here the more dividends you pay out, the more tax. The less dividends, the less tax, or the higher capital gains is the lower tax, because the capital gains is considered as a tax shelter.
Yeah.
Okay? So this is the income funds, but at the end, it means the income funds. It's two-edged sword or two-edged sword. What it means? It means two-edged sword. Like this is the knife, and it has 2 edges. This edge and this edge. Yes, two-edged sword. It means it's fine. You secure the cash, but you pay higher tax.
Yes.
So it's a complex to decide to have income or to have growth. And one more thing. When you are receiving the cash, you receive the cash now. But if you're talking about the capital gains, you miss the time value of money. Okay? So people try to trade off between the cash received or the capital gains, the growth. It depends. So we cannot tell that dividends is much better than growth or retained earnings is much better than. We should trade off. Depends on the criteria of the underlying investors. Okay? Any question? Any question? No? Growth and income funds is a combination between them, between the two assets. Specialized funds. Specialized funds is designed for a particular investors. For instance, if they'd like to invest in companies having social responsibility, for instance, this is a specialized funds. So the design, their portfolios depends on the specialized funds. Or some people, they prefer to invest on money markets only, in liquid, very liquid assets, which is specialized funds. And so they prefer to invest in different sectors, like I explained in the social responsibility. Some people, they like to invest in technology, invest in different geographic areas in Malaysia, for instance, in South Africa. It depends. Bonds funds specialize their investment in bonds, in index funds. This is important. The index funds is considered as a lower risk because it is copying the index. It's copying the market return. How they do this, index funds? Let's, for instance, have this example. We have a New York Stock Exchange. And you know New York Stock Exchange? You have experience on this?
Secondary market.
Okay. Today, okay, Sunday, tomorrow, Monday, at 4, they try to open the CNN or the Bloomberg TV at 4 o'clock, and you will see a man standing like this and having the handle and knock on the table. It's saying declaring, starting the trade. So in New York Stock Exchange includes thousands of companies. Thousands. And this guy is looking at different companies, and he messed around. Because if you look at 5,000 companies, which one to invest? This one, or this one, or this one, or... Okay, you have 5,000. You spend a lot of time in looking what is good for you. The index fund is make this for you by tracking the index. How they track the index? You know, the New York Stock Exchange rank the companies according to their performance. The first 500 companies are ranking like this, and they form S&P 500s. S&P 500 is ranking the best performed companies till the lowest one. In this case, this guy, he doesn't need to mess around because he knows this is the best and this is the worst. And if he wants to be more relaxed, just leave his money with the index funds. So the index funds, they work on behalf of him, because every quarter the S&P 500 committee, they change this list according to the performance of the companies. So this guy, he doesn't need to do the investigation who is the added companies and who is the deleted companies from the list. If you want to be more relaxed, you can go to the London Stock Exchange. London Stock Exchange ranking the first top 100 companies forming FTSE 100. FTSE, the Financial Times. So the FTSE 100, which considered one of the 10th largest economic in the world, it represents one of 10th economic in the world. يعني عشر الاقتصاد في العالم موجود في هذول ال 100 شركة. In Oxford Road. تمام? So in this guy, in this style, you know the first 100 companies listed in the New York Stock Exchange. If you don't need this, you can go to the CAC 40. CAC. Okay? If you don't need this, you can go to the Nikkei 225. Nikkei. This is a Japanese one. 225. It means index tracking is important because you relax. the financial committee or the SEC is helping you to rank them according to their performance. So you as an investor, you didn't need to do investigation. You don't need to do analysis for which company is the best, because already, so don't invent the wheel. The wheel is already invented. Okay? Don't spare the time or doing these things. All of the statistics, all of the analysis are available in their website, and I think you go to the www.icc.org. All of the mutual funds are available in this website. Just have a time and enjoy. We have tax-exempt bond funds. This tax is totally free of tax. People invest in the tax-exempt bonds are not paying tax. In particular, when you invest in the municipal bonds
There is
and government bonds,
no tax. No tax.
no tax.
Tax free.
And they have different types of bonds. It gives you the guarantee of having the bonds and the guarantee not to paying tax. Single country or regional funds. Some investors, they prefer to invest in a particular country, like in Dubai, for instance. They invest in Brazil, in Africa, in Ghana, in Morocco. Okay, so it depends on. And as I said in the just 20 minutes, you have at least 200 mutual funds. You have different design. You can, okay, I want to invest in Tunisia. I want to invest in South Africa, in Ghana. You can invest in United States. You can invest in the Singapore. So the mutual funds give you these platforms to invest your money. And investors, they have their own exchange traded funds. Exchange traded funds is similar to the is similar to index fund. The main difference between the index fund and the exchange, you don't have the slides. You had experience about this before. So you know about the exchange traded funds. ETF. This is very important.
Economic finance.
ETF. This is the new fashion design in the investments. ETF. Just Google ETF. Google ETF and you will see to what extent this type of investments is growing in the financial markets. Okay, so exchange traded funds, the main difference between index funds and exchange trade fund, this is a stand for ETF. It's important. Okay. In the ETF, they try to have their own index. They try to copying or matching the real index, like New York Stock Exchange, like S&P 500, like the Dow Jones 30, like the CAC 40, like Nikkei 225, like the FTSE 100. And the ETF try to copying this and have their own index by doing analysis for a particular companies and then suggest to the investors. The conclusion, they may end up with the similar companies In other way, you could find the listed companies in the index to extent it is similar to the exchange trade funds, just to ensure that they are in the right way. And the idea of it, ATF, they try to outperform the index performance. They try to outsmart the index funds. Unfortunately, sometimes they outperform the index. Other times they have less performance. But in total, it's close to the index fund. This is in total. Before talk about the specialized, let's talk about go back to the specialized mutual funds. In the specialized mutual funds, some of the mutual funds companies think we don't need diversification, which is against what people think, because people thinking that the more you diversify your portfolio, the higher rate of return and the lower risk. But these specialized funds, they think in different ways. They say, okay, let's do analysis for different economic sector, then to see which sector is growing up, then to channel our funds depends on the performance of each sector. And then they do recategorizing, or they do reanalysis to this every quarter or every year, and then they take investment decisions regarding the investment. In other ways, they try to convince the academic people and convince the institutional investor to say, listen, the diversification is not the best solution. So we can outperform the portfolios by focusing on a particular area in the economic sector. And this is have a lesson from the economists, particularly in the United States and in the UK. They focus on agriculture, for instance. They focus on the technology. They focus on medicine. They focus on expansion. So this is the idea. They don't need to spend the money in different economic sectors, just focusing on a particular sectors. And if the sector is improving, then it is spreading to the other sectors. Some people, they're convinced by these ideas. And as I said, this is like mobile phone industries. Every day we have different styles, we have different instruments. I explained in the last meeting about the investment styles, and investment styles related to the firm size. People invest in the large cap, and this is characterized in the growing companies. You know, the large cap is characterized as any company having more than $10 billion. Yeah, billion dollar. 10 billion. This is considered as a large cap. You see? It means in Palestine we don't have large caps, or we do have. We have large caps. Even all the financial market companies, they don't forming the one mutual funds. Sorry? Mid-size is between 5 to 10. Small cap is 1 billion to 5, or less than 1 billion. Yes, small caps. It means we don't have even small caps. Caps, what it means, caps? No. Sorry? We said large caps. Capital. And how they calculate capital? How they calculate capital? Large market capitalization. So they do abbreviation large cap. Is calculated, the cap is the number of shares outstanding times the current market price. The current market price. This is the cap. So you know now the large caps and the current price times the number of shares outstanding. Okay, so again for the classifications, greater than 10 billion is large caps. From 1 to 10 is mid cap. Less than 1 billion is the small caps.
Between 1 and 5.
Between 1 and 10. Yeah, some classifications say 1 to 5. Okay, so from 5 to 10 and 1 5 to. But the American classification is saying like this. More than 10 billion is large. From 1 to 10 is mid. Less than 10 is small. So according to this categorization or classifications, we don't have mid caps. Okay. I explained the large, mid, small growth value style. What it means, value style? It means the mispriced. The mispriced. It means it's not located in the security market line. It's located here. It's mispriced, or what's called the undervalued. Undervalued. Which is preferable. This undervalued. It's not a pricing. It has no efficient pricing. So the total asset is greater than the market value. When you do analysis, you see the market value is lower than the total assets. So investors, they think this is a good opportunity to invest in the undervalued companies.
Because the price will decrease.
Okay? Capitalization, we explained the growth strategy designed to identify companies that offer exceptional opportunity for capital appreciation. I explained the growth value, a strategy designed to identify companies whose stock price appears to be below some estimate of the firm's intrinsic value, is below the intrinsic value, below the true value of the company. Stocks that undervalued. Advantages offered by funds: diversification, professional management, we explained this, custodial and other services. You know what it means, this? Custodial. It means the mutual funds can invest on behalf on behalf the investors. Now, returns. Advantages do not necessarily include superior returns. I explained this point. It doesn't mean having a mutual funds outperform the financial markets. Outperform the financial market means to beat the markets. But we have conflicts of the conclusion. Some studies find the mutual funds outperform the financial markets, others not. But in general, it's close to the financial markets. Close to the financial markets. And this is tendency to underperform the markets. It's not up to the market, but close to the market. It means underperform. But in general, it's much better than investing in the individual companies. Returns in an efficient market context. The return is efficient. I mean the return of the mutual funds. Factors that affect returns. Expenses. Because as I explained before, you may pay loading fees, 12P1, exit fees, management fees, operation fees. All of these fees decrease the required rate of return. Fees, load fees and exit fees, 12P1 fees. And we explained this. Movement in the markets. And I explained this is free of tax, but some mutual funds, they may pay tax. Some of them. We will stop here, and next meeting, inshallah, we will finish the chapter 5. Bring your calculator next meeting, because a lot of calculations will be in the before you moving. In next meeting, we will talk about the risk-adjusted return. Okay? By using 3 formulas, we have three formulas. Try to prepare these formulas, and then try to read the CAPM, Capital Asset Pricing Model. The CAPM is in the financial management, so I don't need to talk about the CAPM, just to give you little brief about the CAPM. Then we build our formulas depends on your understanding of the CAPM. Okay? Take your time and enjoy.